We start off with a record-breaking first half finale. The S&P 500 hitting another all-time high to close out the first half of the year with a 14% gain. So things are off to a great start. Our next guest says, just wait, it's about to get even better. Really? FUNDSTRAT's Tom Lee just hiked his year-end S&P 500 price target by 7% to 4,600. That ties for a street high. Tom joins us right now. Tom, great to have you with us.
Great to be here.
You're not worried about slowing growth compared to earlier this year, an economy that reopened in the first half of the year and an economy that will sort of normalize in the back half of the year with the threat of tapering in some form?
I think that, I don't think recovery is a straight line up, but from what we can tell, looking at both earnings revisions and conference calls and really talking to clients and businesses, I think there's still quite a lot of pent-up demand. I think both on the consumer side, right, there's the revenge spending, and then with both wealth effect and rising stock prices, strong credit markets, I think there's a corporate CapEx cycle coming, which is essentially corporate revenge CapEx. So I think there's a lot of positive catalysts for surprise in the second half.
So you still like energy? Energy was a sector leader first half. You think that's still a winning ticket in the second half?
Yes. To us, energy really sits in a special spot because I know investors, kind of cool to the idea of some inflation plays, but energy and oil really is a supply-demand sector that's got very attractive fundamentals, and then energy stocks have a huge catch-up trade to that. So it remains our top idea.
Tom, sorry, the COVID trade, excuse me. Where are you on names that really actually underperformed in the first half of the year after being the story of 2020? So to the extent, I know you spend a lot of time going through screens and evaluating underperformance. There are some really gross underperformers in the first half of the year. What do you think about some of those trades?
Tim, if you're referring to some of the secular growth and like the FANGs, I think they're going to be leaders in the second half. I think their turn really came when interest rates and the panic about inflation cooled off in March, and that's shortly after those stocks bottomed. But when I look at the second half, I think you're absolutely right. If the S&P is going to end the year up 25%, and our rationale for doing that is that strong markets stay strong, then something like Apple or Amazon, which are up 4 or 5%, they could have a second half of 20% just to catch up to where the S&P ends the year. So I think there's going to be a huge amount of price appreciation coming from tech and FANG and some of these secular growth names. And part of it is, we're not necessarily out of the woods in terms of COVID as well. I mean, I think there's still some uncertainty from investors and their willingness to embrace epicenter stocks broadly.
Tom, how much attention are you paying to the 10-year yield, being as though it's sort of range-bound and you have both value and growth? Are there any flags that you're worried about as far as yield exploding or falling?
It's a great question. I mean, I don't disagree with the consensus view that rates should be higher in the future, because we have reflation and we have an economy that's recovering. And I think in general, activity picks up. So there should be sort of reflationary pressures plus the millennials. But I think it's really a question of timing. And to me, I think investors thought there was some urgency about where rates would move to and maybe a bit of a panic about that. And, the belief that the Fed was behind the curve. Now I think there's kind of a realization the Fed may be correct on a lot of parts of that transitory argument. So I think rates in the shorter term probably undershoot people's expectations. And then that's great for the FANG trade as well.
So, Tom, I don't disagree with you. I fully agree with you when it comes to the FANG trade, but I've got a question for you about Bitcoin. Where do you stand right now? We've had this volatility of Bitcoin where we were up above 60,000, pulled back underneath 30,000, and we've been kind of hanging right around this area right now, at least for about 36,000, 35,000. Where do you stand right now? Do you see more upside at this point in time, or do we see ourselves just sort of backing and filling?
I think Bitcoin's acted really well because, the rug was pulled out from under it this year from both the combination of like the threat of, taxation and regulation in the U.S. and then essentially an outright national ban in China on mining. I mean, those two things could have caused a crypto winter, but instead Bitcoin really held around 30,000, which I think is a really important level. And now I think, look, it's going to consolidate for a bit, but I don't think it's impossible to say that Bitcoin could exit the year around 100,000. So I think we're still, in the bigger fractal, still a long-term positive story for Bitcoin. It's really about both the transformation of the financial system, but also the fact that it's a generational play. I mean, this is one of the big sort of, multi-decade stories, and I think it's really held up well in the face of bad news.
Tom, I wanted to sort of dovetail off of the rates question. When do you think the market starts to anticipate higher rates because of the Fed tapering? And I'm wondering if that comes, it sounds like you don't think that it comes in the back half of the year, or you think that the markets can see tapering in the cards and not react poorly to it, be just fine.
Yeah, I'm probably more in the second camp. This most recent FOMC meeting was really the Fed taking off some of the tail risks related to COVID. And so I think that was the shock that went through markets. And the S&P not only actually acted pretty well. I mean, June was a great month, but interest rates cooperated too. So I think it's very possible that we could have a 2% 10-year by the end of the year, and we're still S&P 4600, and FANG could have a great year because, at a 2% 10-year, you're paying 50 times for a government bond. And I think FANG doesn't look expensive at 30 times. So I think there's still a huge TINA or relative trade on owning equities over credit, even at a 2% 10-year.
All right. Tom, thanks so much for joining us. We do appreciate it.
Great.
Tom Lee of FUNDSTRAT. You can read more about Tom's market call on our website, cnbc.com/pro. Guy, what's your take on being much more bullish, or more bullish, I should say, from where we are right now?
He's done extraordinary work. I mean, if you listen to Tom, watch Tom, been on the show a number of times. I mean, he's been pretty steadfast, and being steadfast, he's been spot on. So, far be it for me to cast aspersions one way or another. I think it's interesting in the last comment about you could see 2% at the end of the year in the 10-year and still see the market to his level along with FANG. That's a really interesting scenario that actually might play out. I'm not certain I see that happening, but you got to respect Tom's work. What I will say that we haven't talked about yet, and Tim brought this up last night, we've been bringing it up for quite some time, the leaders of this group, the leaders of the market have been the semis, and look at where the SMH closed today. I want to say, an all-time high, that 255 level had been resistance on the upside. We blew through, and some of these names have just been parabolic for good reason. So as long as the semis can continue to move higher, at Steve's point, the 10-year, which has been vacillating between 145 and 155, there's no reason to believe that the S&P won't go higher as well.
I sort of caught on to that tech comment as well, in terms of the yields going higher and tech going higher, and also that tech will be a performer in this environment when it was a top performer in the pandemic environment. Can you have it both ways, where tech is the growth engine when the economy is stalled or down and out, and tech can be the growth engine when the economy is reopened and reflating? Tim, what do you think?
I think you can. I think big mega cap tech is growth at a reasonable price, and I think they've been very defensive during periods where we've seen growth call under pressure. Everyone here has just pointed out, and Steve pointed out, the fall in the 10-year, totally disproportionate, or I should say inverse to what happened with the dollar. So the second quarter was really about a move lower in yields and a sense that the industrial kind of value story from the first quarter was giving way to what was really punctuated only at that Fed meeting. In other words, those trades were already starting to work. But if you look at where we are year to date, some of the real underperformers arguably have been Apple, have been Amazon, up 2%, 5%. So I actually think that they are positioned for all-weather stocks in the second half, because if we got COVID again, Amazon's going to outperform. Let me restate that. If we actually have a resurgence and we are pulling back and the economy gets at least under the pressure of those headwinds, I think some of those same trades, at least in the mega cap tech land, work both ways.
Yeah.
Lumber is in 57% in 37 trading sessions. So everyone that was worried about inflation and was pointing to those types of things, yeah, sure, and crude has managed to be up too. Yeah. But there's still a handful of things that are transitory. So there's no blanket statements either way, right? So that's the way I look at it. And Tom sees that. I don't see above 2% everything working. I think right here between 155 and 175.
And Tom was careful to say it's FANG. So we're talking about, as Tim mentioned, mega cap growth stocks, Pete. What happens to high value tech at 2% yields? Software, for instance. What do you think?
Well, yeah, it's a great question, and I guess it depends on what these guys were just talking about, which would be the variant or any, kind of an extension of what we'd already just gone through in 2020. So without that, I think that many of those names probably have some sort of a chance, Mel. But I think the reality is the names that I think folks would go for are the names that hit the pause button in a big way. And these guys were pointing it out, whether that means it's Amazon, which really hasn't done a whole lot, or it could be Apple, which hasn't done a whole lot. But they did have that the second half of 2020 where they just absolutely were ripping. And everybody said, well, the markets are going higher, but it's only because of FANG. And then suddenly it became financials and it became energy and it became materials. And those took there. So I think there is this healthy sort of rotation consistently that we have been going through. And I think we could very easily see that once again, whether that means it's those high multiple stocks that maybe kind of kick back in. If there is any kind of a slowdown economically, they certainly would be some of the names that I think would probably start moving back up to the upside once again. But it really is interesting, Mel. I don't know if it's as much about the 10-year right now as it is more about the backdrop of what the potential from a medical standpoint, what's going to be going on over the next 6 months.
Shepard Smith here. Thanks for watching CNBC on YouTube.